Hello, this is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook. Welcome to our deep dive for today.
Thanks. Yeah, it's a pretty wild week to be diving into all this data with you.
It really is. I mean, right now, global geopolitics feel like they are just, well, on fire.
Right. Absolutely.
We're seeing military strikes, shipping lanes being threatened, dire warnings from world leaders. Yet, if you look at the Japanese stock market, it just surged by like 3,800 points.
Yeah, which is huge.
Exactly. So today we are going to explore this massive decoupling for you. We'll unpack why the stock market seems to be aggressively ignoring reality, and then how the currency market is actually absorbing all that fear. And finally, we will map out the specific economic tests hitting the calendar this week.
Yeah, to keep things simple for you listening at home, we're basically breaking this down into 3 sections.
Right.
First, this week's stock market outlook. Second, focus materials and foreign exchange movements. And third, a really detailed weekly timetable.
Perfect. Because, I mean, it is a profound disconnect, right?
Oh, definitely.
Yeah.
You have equity traders operating with this incredible optimism about the future, while foreign exchange traders are basically battling daily geopolitical whiplash.
Yeah.
Understanding the mechanics of why these two markets are behaving so differently right now is, well, it's crucial for making sense of the broader economy.
So let's start with the first section, the equity side.
Yeah.
Because the sheer scale of the numbers it's hard to ignore.
It really is.
Like, the Nikkei has completely broken out of that 54,000 yen holding pattern it was stuck in. It surged to 56,924.1.
Right.
And the 2PIX is also up, hitting 3739.85. And, this is happening against the backdrop of Israel launching airstrikes on Lebanon, literally right after a U.S.-Iran ceasefire agreement.
Yeah, the timing is chaotic.
And then you have Iran threatening to close the Strait of Hormuz. I mean, historically, when the Middle East destabilizes, oil prices spike.
Right, exactly.
Companies face higher input costs, profit margins compress, and stocks drop. It's a very reliable chain reaction. So why is that correlation completely broken this week?
Well, the historical correlation hasn't vanished, but it's being overwhelmed by a totally different mechanism right now.
Okay, how so?
Well, the stock market, it functions essentially as a weighing machine of future cash flows. And right now, the market is placing 2 very distinct items on that scale.
Right.
On one side, you have the immediate geopolitical smoke and, the threat of oil disruptions. But on the other side, investors are pricing in diplomatic hope. They are specifically looking toward the U.S.-Iran peace negotiations happening in Islamabad, Pakistan on the 11th.
Okay.
And the potential for historic peace talks between Israel and Lebanon.
So they are betting that the diplomacy outweighs the current conflict?
Exactly.
But diplomacy takes time, and markets usually hate uncertainty. There has to be something else on that scale pulling the numbers up so aggressively.
Oh, there is. The real anchor on the positive side of the scale is the massive expected profitability of the AI and semiconductor sectors.
Oh, of course. AI.
Yeah. The market is basically saying that the future cash flows generated by artificial intelligence infrastructure will be so enormous that they'll overshadow any short-term margin compression from higher oil prices.
Wow.
We've seen what analysts call guidance risks fading away over the last few weeks.
Let's define guidance risk for a moment, just because that term gets thrown around a lot in financial media.
Sure. Think of guidance as a company's own official prediction for its future sales and profits.
Okay.
A guidance risk is the fear that a company will come out during earnings season and say, well, actually, the next few months look a bit weaker than we thought.
And when they do that, the stock tanks.
Exactly. When companies lower their guidance, stock prices plummet because that future cash flow calculation suddenly shrinks.
Right.
But right now, the fear of lowered guidance in the tech sector is basically evaporating. Investors are highly confident heading into the upcoming earnings reports.
Which explains the incredibly wide forecasted range for the Nikkei this week, right? Because we are looking at an estimated band between 53,900 yen and 58,900 yen.
Yeah, it's a huge spread.
It implies a lot of upward momentum. So is the stock market basically like a seasoned surfer who has stopped looking at the choppy water right in front of them and is instead entirely focused on like the perfect wave forming on the horizon?
That is exactly it. That's a great analogy. They're watching that AI wave. However, While equity traders are staring at that beautiful wave on the horizon,
Hmm.
currency traders are they're drowning in the geopolitical chop right in front of them.
Yeah, that's a whole different story.
The foreign exchange market is definitely not ignoring the Middle East. Not at all.
Which brings us perfectly to our second section, the focus materials and foreign exchange data.
Right.
We're seeing an operating range for the US dollar to Japanese yen pair set between 156.5 and 161.000.
But to really understand this, I think we have to look at the severe whiplash that happened between April 6th and April 9th.
Oh, absolutely. The currency market was just a pure reflection of global anxiety during those 4 days.
Yeah.
On April 6th, as Middle East tensions were smoldering, we saw a massive wave of what is known as emergency dollar buying.
I actually want to push back on that concept for a second, if you don't mind.
Go for it.
If there is a major geopolitical crisis brewing and the United States is deeply involved in managing it, why does capital flood into the U.S. dollar?
That's a fair question.
Like, shouldn't a global crisis involving the U.S. actually hurt its currency?
It is a bit counterintuitive, I'll give you that, but it really comes down to liquidity and the structure of global debt.
Okay.
The US dollar is the world's primary reserve currency.
Hmm.
In times of extreme panic, global institutions, corporations, governments, they all prioritize one thing:
Having cash.
having access to the most liquid, accepted currency on Earth to meet their obligations.
I see. So they sell off riskier assets, like emerging market currencies or stocks,
Mm.
and they buy U.S. Treasury bonds, which are priced in dollars.
Right.
This massive influx of capital mechanically drives the value of the dollar up against currencies like the Japanese yen.
Okay, that makes sense. And we saw that panic accelerate on April 7th.
We did.
The market was already on edge waiting for a negotiation deadline, and then U.S. President Trump issued a statement warning that a civilization might be destroyed.
Yeah. And when rhetoric of that magnitude enters the news cycle, algorithmic trading systems and human traders alike, they react instantly.
Just immediate panic.
Right. The uncertainty premium skyrockets, and the dollar strengthened even further as that flight to safety intensified.
But then the very next day, April 8th, the reports came out that a 2-week U.S.-Iran ceasefire had been agreed upon, and the dollar immediately unwound those gains. The yen strengthened.
Exactly.
Then on April 9th, Israel attacks Lebanon, Iran issues new threats regarding the Strait of Hormuz, and the dollar shoots right back up.
It was relentless.
So if I'm trying to predict the dollar-yen movement right now, is the U.S. dollar basically functioning as a real-time fear gauge? Like, if peace talks succeed, the dollar drops. But if they fail, does inflation fear keep U.S. interest rates high and push the dollar up?
You nailed it. It is absolutely functioning as a fear gauge. But the mechanics connecting the Middle East to the U.S. dollar run directly through the global inflation cycle.
Right.
If peace talks fail and conflict escalates, the primary economic consequence is a disruption in oil supply. And higher oil prices immediately feed into higher inflation in the United States.
And if inflation in the U.S. goes up or, even just stays sticky, the Federal Reserve can't cut interest rates.
Exactly the opposite. They might be forced to keep rates high for much longer than anticipated.
Wow.
And high interest rates yield better returns for investors holding U.S. capital. So global money flows out of Japan, where interest rates are comparatively much lower, and into the United States to capture that yield.
Okay.
This interest rate differential is the core engine pushing the dollar up and pulling the yen down.
So if we are tracking this tug of war for the listener, what are the specific technical boundaries that matter this week?
Well, there are two critical lines in the sand you need to watch.
Okay.
The upper ceiling is 160.46, which was the peak hit back on March 30th.
160.46. Got it.
If the dollar-yen pair pushes toward that number again, the market will go on high alert for foreign exchange intervention by the Japanese government.
Let's clarify how that intervention actually works. If the Japanese Ministry of Finance decides the yen is too weak, what do they literally do?
They step into the open market using Japan's foreign currency reserves.
Okay.
The Bank of Japan, acting on behalf of the Ministry of Finance, will sell massive amounts of U.S. dollars and simultaneously buy Japanese yen.
Just flood the market.
Exactly. This sudden overwhelming demand for the yen forces its value up, and the mere threat of this happening, the psychological barrier of that 160.46 level, it often acts as an invisible ceiling.
Because traders don't want to get burned?
Right. They don't want to be caught betting against a central bank that has billions of dollars in ammunition.
Makes total sense. And what about the floor? Where does the dollar stop falling if the news cycle suddenly improves?
The critical support level is 156.78.
Okay, 156.78.
Yeah. That specific number represents the 100-day moving average as of April 9th.
For those who don't spend their days looking at technical charts, why does an average of the last 100 days even matter?
Because modern financial markets are heavily driven by automated algorithmic trading.
Ah, the bots.
Exactly. These computer programs are coded to look for historical averages to define trends. The 100-day moving average is a very widely programmed line in the sand.
I see.
When the currency drops to that level, thousands of algorithms automatically trigger buy orders, believing the asset has hit its natural floor. It basically creates a self-fulfilling safety net.
That's fascinating.
Also, while watching these levels,
Hmm.
any public comments from Bank of Japan Governor Kazuo Ueda will be heavily scrutinized. A single sentence from him about future rate hikes can instantly reprice the entire currency pair.
So we have a week where the market is balancing the threat of inflation, the promise of massive AI growth, and the constant hum of geopolitical risk.
It's a lot.
It is. And tracking all of this requires a roadmap, which naturally flows into our third section, the detailed weekly timetable.
Yes, let's get into the calendar.
Because looking at the data drops scheduled from Monday to Friday, it feels less like a random assortment of economic reports and more like the global economy is taking three massive overlapping tests.
Oh.
Yeah, I'd call them the inflation test, the economic growth test, and the AI earnings test.
That is a very effective framework for approaching this calendar. Let's trace how those tests unfold, starting on Monday, April 13th.
Okay, Monday.
Monday is essentially the market catching its breath. In Japan, we see the release of the March money stock data. Overseas, India releases its March Consumer Price Index, and the U.S. reports existing home sales.
It's a gentle start, but we also get Goldman Sachs kicking off the U.S. bank earnings season.
Right, which serves as a prelude to Tuesday, April 14th, when the tempo dramatically accelerates.
Tuesday is busy.
Tuesday is where the inflation test really begins. Domestically, the Japanese Ministry of Finance is holding a 20-year Japanese government bond auction.
Okay, why should we care about a 20-year bond auction?
Because it reveals the long-term expectations of massive institutional investors. If demand for these 20-year bonds is weak, it means investors expect Japanese interest rates to rise significantly in the future.
Right.
So they don't want to lock their money away at today's low rates. It's basically a pure barometer for domestic monetary policy sentiment.
Got it. And then we look overseas on Tuesday. China releases its March trade balance, and the IMF updates its world economic outlook. But the big inflation metric drops in the U.S. with the March Producer Price Index, or PPI.
Yes. The PPI measures the costs that businesses pay for goods before they reach the consumer. If producers are paying more for raw materials today, they'll inevitably pass those costs on to the consumer tomorrow. It's a leading indicator for the broader inflation cycle, which directly impacts the interest rate expectations we discussed earlier.
So Tuesday is huge for inflation, but it also brings a heavy roster of U.S. financial earnings.
It does.
We have BlackRock, Citigroup, JP Chase, Wells Fargo, and Johnson & Johnson. These aren't tech companies, so how do they fit into the broader narrative?
Well, these companies represent the bedrock of the U.S. consumer and corporate economy.
Right.
If JP Morgan and Citigroup report that consumers are defaulting on their credit cards, or that businesses have stopped taking out loans to expand, it signals that high interest rates are finally cracking the economy. It tests the resilience of global demand.
Then we hit Wednesday, April 15th, which is where the data shifts heavily toward the growth test and the start of the AI earnings test.
Yes. In Japan, we get February machinery orders.
And the machinery orders are a vital leading indicator, right?
Very much so. If a company is buying massive, expensive industrial machinery today, it means they are highly confident about their production needs 6 to 12 months from now.
That makes sense.
We also see the release of Japan's March foreign visitor numbers, which is basically the defining metric for the health of inbound consumption in the retail sector.
Okay, and over in the U.S. on Wednesday, we have the NY Fed Manufacturing Index, export and import prices, and the NAHB Housing Market Index.
Right.
But there is a specific report from the Federal Reserve coming out called the Beige Book. What exactly is that, and why does it matter alongside all these hard data points?
Well, while things like the PPI give us rigid mathematical data, the Beige Book is entirely anecdotal.
Anecdotal.
Yeah, and a compilation of interviews and on-the-ground reports from bank branch managers, local business owners, and economists across the Federal Reserve's 12 districts.
Oh, wow.
It provides the qualitative color, the why, and the how behind the raw numbers. It tells us if businesses are struggling to hire, if supply chains are backed up, or if local consumers are cutting back on spending.
That's super useful. But the crown jewel of Wednesday isn't the beige book. It's the first major event of the AI earnings test.
Yes, we get earnings from ASML Holding.
ASML.
They are the European giant that manufactures the extreme ultraviolet lithography machines.
The ones that make the chips.
Exactly. The incredibly complex, multi-million-dollar equipment required to physically print the world's most advanced microchips. They don't design the AI software, they build the machines that make the AI hardware possible.
Right.
Their forward guidance will immediately dictate the mood for the entire global semiconductor supply chain. We also see major U.S. bank earnings, continuing with Bank of America and Morgan Stanley on Wednesday.
Okay, so if Wednesday sets the stage, Thursday, April 16th, is the undisputed climax of the week.
Oh, Thursday is monumental.
This is where the growth test and the AI test both reach their peak.
It begins with China unleashing a massive data dump covering the first quarter. We'll see Q1 GDP, March retail sales, industrial production, and urban fixed asset investment.
How heavily does the Chinese GDP number weigh on the markets we've been discussing, like the Nikkei or the US dollar?
Immensely. China is the world's second largest economy and the primary engine for global manufacturing demand.
Right.
If Chinese retail sales are sluggish and industrial production is down, it means they are buying fewer raw materials and fewer exported goods from countries like Japan and Germany.
Ah, I see.
A weak Chinese GDP print can drag down global growth expectations instantly.
Meanwhile, the U.S. releases the Philly Fed Index and industrial production data. And geopolitically, the IMF and World Bank spring meetings continue in Washington, D.C.
A lot's happening.
But the main event of Thursday, the ultimate AI test, is TSMC.
Taiwan Semiconductor Manufacturing Company. While ASML builds the machines, TSMC is the world's largest contract chip maker. They physically manufacture the chips designed by giants like Apple and NVIDIA. Their earnings report, and more importantly, their forecast for the next 2 quarters, acts as the definitive crystal ball for global AI hardware demand.
So they are the bellwether.
Absolutely. If TSMC says orders are accelerating, it validates the entire stock market's optimism. We'll also see earnings from Netflix, Travelers, and U.S. Bancorp on Thursday.
Okay, wait. With data pouring in from the US, China, and Japan, there's a huge risk of information overload here.
True.
If our listener only has time to pay attention to one specific 48-hour window to see where the global economy is heading, it has to be that Wednesday and Thursday tech and GDP combo, right?
I would agree with that completely. Wednesday and Thursday are the crucible.
Yeah.
You have ASML and TSMC providing the definitive test for the AI stock market thesis. You have China's GDP testing the global growth thesis.
Right.
And you have the U.S. Fed's beige book and inflation data testing the interest rate thesis, which directly drives whether the dollar pushes toward that intervention line of 160.46 or falls back toward its moving average.
And finally, we reach Friday, April 17th. The calendar seems to kind of step back and let the dust settle.
Yeah, it's definitely a day for digesting. The primary release is the Eurozone's February trade balance. By Friday, the market will just be processing the sheer volume of information from the previous 48 hours.
Let's pull all of this together. If you are tracking the markets this week, you are watching a remarkable balancing act. The stock market is choosing to ignore the immediate geopolitical friction in the Middle East, acting as a weighing machine that is heavily favoring the future cash flows of the AI revolution.
Right.
Meanwhile, the currency market is absorbing the reality of the geopolitical tension, with the dollar acting as a gauge for inflation fears and the persistent gap in global interest rates.
And tying it all together is that dense, high-stakes calendar.
It's going to be a wild ride.
It is. And, as we conclude this analysis, there's a lingering question we really have to consider.
What's that?
Well, we noted that the stock market has essentially priced in a positive diplomatic outcome in the Middle East, and it has priced in explosive, near-perfect forward guidance from tech giants like TSMC and ASML.
Right. Price for perfection.
Exactly. But if the broader market is priced for perfection, what happens to these massive Nikkei gains if even one of those expectations falls short?
Oh, wow.
Is the equity market too complacent right now, just assuming the geopolitical smoke will simply clear on its own?
That is a great point. That perfect AI wave on the horizon looks incredibly inviting, but the market still has to survive the geopolitical chop to actually ride it. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.